the Dow has broken back under the 20,000 level to start the new trading week. Even worse, this significant breakdown comes at a time when a number of other bearish indicators are starting to align, suggesting the potential for a correction not only in the short term, but perhaps increased volatility throughout 2017. We'll show the U.S. market here over the last little while. It had a huge rally following the U.S. election. It spiked down towards 17,470 and then just rallied up from there. And it's been quite a bit of time hanging around between about 19,700 and 20,000. Recently broke through, but it was only able to, the parties really only lasted for a couple of days, and now we're seeing it roll back over again. Not only has it broken, it's now, it looks like it could be retesting 20,000 as resistance. If it wasn't for the fact that this is 2 days instead of one, this would be an evening star candle pattern here, especially with the big upward candle. It normally would be 1 day. Here we've got two days of spinning tops, and then look at this gap down to start the week and starting to pull lower, and a break of a major psychological level at Dow 20,000 for the US 30 market. This is all suggesting quite bearish here. Next downside support in and around between 19,660 and 19,700 around this 50-day moving average, and then here a 23% retracement of the recent rally could take you back towards 19,490, 19,500. We'll note here, market had been overbought. RSI has been trending down. We did get this one last scope. This is feeling more like something like a throw over or a buying climax or something like that. And now that 20,000 is being achieved, it's now looking like some people are more interested in taking profits. If we look at the 1 minute chart today, we'll see that we did get our break of 20,000 and then the bottom fell out. And then now we're seeing it starting to bounce back. We've only even still gotten back to 19,930. You could retest this 20,000 as resistance, but if you retest it and it failed, that would just be more confirmation of a big breakdown going on. I'm going to shift now and do something a little different with this one. I'm going to show some slides from a recent presentation I've done on a number of different markets, which is here. So, starting off with the Trump honeymoon and the potential for a correction, I think the reason why we're seeing the market start to give way is that they'd really priced in Trump to perfection, that everything he would do would be great for the economy and there would be no disruption, no problems. Well, clearly we're seeing from the executive order related to refugees and immigration and the chaos that's ensued at airports and protests and problems that things aren't going to go perfect, and that it's a bumpy ride, and that major policy changes are volatile and there is uncertainty attached to them, and I think that's quite important, and that's why we're seeing the market start to correct. When we look back to previous honeymoons, we can see for previous Republicans on their first time in office, in November, December, you had for most of them 1 month was positive, 1 month was negative. Didn't matter which one, but one was each. Trump had 2 huge months. The last time we saw that was Eisenhower, 2 huge months in November, December. What happened to Ike? 1, 2, 3 months of negative returns in January, February, and March. Trump so far is still looking positive on the month, but certainly there is the potential for a significant correction here. When we look now at the lunar cycle and looking at the year of the rooster, we're also seeing potential for volatility. Rooster years, generally speaking, have been positive for the markets. However, they've also been very volatile. When we look at the S&P, you've had massive returns. You've also had big losses. When we look even at the Hang Seng, huge returns, 10% plus losses. Same for commodities, same for the FTSE, same for Australia and Canada. Huge years. Either you could have a 20% gain, you could have a 20% loss, a 40% gain in the S&P TSX, depending on the rooster year. The one thing that seems to be consistent, it's really volatile. And now when we look to the Super Bowl indicator, we're also seeing the potential for volatility. Last year, the big win by Denver Broncos and Mannings was positive for the markets. Just after that game, the markets bottomed out for the year. They were down substantially, and they finished up quite nicely. So Mannings have done very well. The markets like the Mannings when they play in the Super Bowl. They're up about 12% since 2010. In the years that outperforms the years of no Mannings. This is a no Manning year. So overall, and Peyton had a positive short-term return, 9.2%. His average is pretty close to what the market pulled in last year. Denver plays 9.5%. That's actually what the market ended up gaining last year. Denver wins even better. Huge returns short term. Denver Peyton Manning 1 was great for the market last year. However, the short-term gain could lead to long-term pain. Why? Because over the longer term, we've also seen that the wins by Peyton Manning and Denver have also coincided with peaks of bull markets. In 98, Denver won, and yes, the market was up huge on the year, but in the middle of the year, there was a 19% plunge in the summertime before the markets regained themselves. 99, Denver wins. January 2000, markets peaks and goes into a 2.5-year bear market. That saw the Dow drop 37% over that period. The Peyton Manning won his first Super Bowl 2007. The market peaked in October of 07 and then went on a 2.5-year bear plunge that took it down over 50% of its value. So now we've got Atlanta and New England in the big game this year. Atlanta has only been in the Super Bowl once. They were in 1999, was the peak year of a bull market. New England and Bill Belichick in the big game. Bill Belichick not only has been several times with New England, but he also won a couple of times with the Giants before that. The one thing that's consistent about Belichick, even though his average doesn't seem like very much, 2.7% return if he wins the Super Bowl, but there's huge variations. It's just in both directions. So, for example, we can see there's a 26% gain, a 30% gain, a 23% loss, a 38% loss. The markets really move when Belichick's in the Super Bowl, and also New England, when the market has not been happy about having New England in the Super Bowl since the year 2000. Years with New England in the Super Bowl average 6% decline. Doesn't matter if they win or lose. We had in 2002, the New England won, the market went down 23%. In 2008, New England lost, the market went down 38%. New England has been tied with big bear market years, so keep an eye out for that as well as we move into 2016. And I know a lot of people will sit there and say, "Oh, Colin, you can't call the market off of the Super Bowl," but actually, it's been reasonably successful. In the 2015, New England won the Super Bowl. I called a rough year for the markets. Where we were in a big bull market at that point, and what happened? It's one of the very few down years so far this decade was when New England won the Super Bowl in 2015. Although interestingly enough, in 2012, when they lost the Super Bowl, the markets went up 13%. So there is quite a variation in these results, but in that case it was right. In 2016, we had a huge market sell-off to start the year. The markets were way down. I did call, however, off of the Broncos and Manning winning the Super Bowl, that the markets would go up 10% or be up 10% or more by the end of the year. I got pretty close to that with a 9.5% gain. I correctly called Brexit and the vote leave, that the vote leave win would kill the pound but ignite the FTSE, and I also correctly called that Donald Trump would win the U.S. election last year, and the election night sell-off got to within 40 points of my downside target. So what we're saying here is I'm thinking that based on a number of these indicators, what we're seeing with the stock market action today, what we're seeing with the presidential honeymoon potentially ending and the possibility of a correction, and then the potential for high volatility this year from not only the Super Bowl participants, last year's Super Bowl participants, the Chinese cycle, the presidential cycle. We're in year one. Year one means presidents do the most unpopular measures first. I think we're certainly seeing that since Donald Trump got sworn into office, and then things may change as his term progresses, but a lot of things are coming together into a witch's brew that could create a lot of volatility for the markets in 2017.